Hello, this is Ryan Ray of AAII. We are live talking about the latest and greatest from the world of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we post our upcoming live show schedule on aaii.com/webinars, and AAII members will have access to the full archive of shows. My guests for today's episode are Brian Haughey, Derek Hageman, Charles Ruplet, and Wayne Thorpe. Today's show has three topics. In our first segment, we're going to talk about the Dividend Aristocrats, this list of select dividend-paying S&P 500 stocks, and discuss how to determine which ones provide the safest dividends. In today's second segment, we're going to talk about figuring out your own tolerance for risk as a part of AAII's individual investor wealth building process. And finally, in our third segment, we're going to cover recent stock trends we're seeing among the portfolios in AAII's Stock Superstars report. Plus, our listener mailbag segment where we answer your questions. Let's get started. All right, we have Brian Haughey with us, and Brian, you have an interesting article in the March 2021 AAI journal that looks at dividend-paying stocks and the Dividend Aristocrats. Can you tell our audience a little bit about the Dividend Aristocrats approach and what an investor might want to consider before investing in a strategy like this for their portfolio?
Sure, Ryan. Thanks for having me here. It's always good to take part in helping out the AAII. So the Dividend Aristocrats, as the name might suggest, these are sort of like royalty in the market. So an aristocrat, Dividend Aristocrat, it's an S&P index, and it's a company in the S&P. An aristocrat is any company in the S&P 500 that has paid and consistently increased its dividends for at least 25 years in a row. They also need to be large cap companies, so they need to have $3 billion of shares outstanding and an average daily trading volume of 5 million for the last 3 months. And the index gets reconstituted every year and then rebalanced every quarter as companies publish their reports. So these companies tend to be leaders. They tend to have sustained competitive advantages and produce consistent returns. Their dividend yield tends to be higher, obviously, than other companies in the index, because in the S&P 500, because some firms don't pay dividends. So the dividend yield right now is about 4.5% versus 1.5% for the S&P 500 broader index. And so the dividends are quite attractive. And there's about 65 companies in the index right now, and these are household names, companies that have been around a long time. So the likes of Coca-Cola and Pepsi, Colgate-Palmolive, McDonald's, Target, firms like that. There's always going to be at least 40 firms in the index, and if necessary, the 25-year requirement can be reduced down to 20 years of dividends, and no sector can be more than 30%. And I think as we go forward, we can talk a little bit more about the sector allocations and how that can be a concern to investors.
Great. Hey, Brian, I just have a question. This is Derek Hageman. I'm the financial analyst and editor for AAII's dividend investing portfolio. And I was just curious, how has the Dividend Aristocrats index performed against the broader S&P 500 over, say, the last 20 years or so?
So as you might expect, the firms in the Dividend Aristocrats, they've actually performed really well over the last 20 years. Not surprising, because they're such large blue chip companies, well-known names. So through December 31st, 2020, they've actually delivered a whopping 707%. So that's about just under 10.5% annually. And compared to the S&P's 284%, or about 6.6% annually, it's very, very impressive outperformance. However, what we have seen is that outperformance has reduced in recent years. So over the last 10 years, the aristocrats have just pretty much managed to match the performance of the broader S&P 500. And in fact, over the last 5 years, they have underperformed by about 2 to 3% annually for the last 5 years.
Your article does a deep dive analysis on the recent performance of the Dividend Aristocrats index and how it has underperformed the S&P 500 index in recent years. Does the underperformance have anything to do with some firms preferring to return capital to shareholders via share buybacks?
Well, that's a really interesting question. So yeah, some firms have moved to using buybacks as the preferred way to return cash to shareholders. And this, in part is due to the tax advantages of capital gains versus the income treatment that dividends would get. However, if you look at a shareholder yield ETF, such as the Cambria ETF, for example, the dividend aristocrats have actually outperformed that even over the last 5 years. So the move to buybacks doesn't really tend to explain, in my opinion, the underperformance of the aristocrats. And by the way, note that some people would criticize dividend investing, and they might say, well, if you need the income stream, why not just sell shares? And you can choose to sell those at your own convenience. But the problem there is that you're really exposing yourself to a lot of market risk. Believe it or not, the top 10 firms in the S&P 500 in a given year may have price swings of up to 40%. So if you're relying on selling shares to get income, you may expose yourself to an unpleasant surprise.
No, that's a good point. And I'm glad you bring that up. Being the editor of dividend investing, I do get that. I hear that argument quite a bit. So I just wanted to move on a little bit, and again reference your article, which again can be found in the March 2021 AAII journal. It's called "Viewing the Sector Exposure of Dividend Stocks Through Aristocrats." So, are there any other factors that dividend aristocrat investors should be aware of in terms of performance? You talked about the performance over the last 20 years. You talked about recent performance. Is there anything related to sector exposure that dividend investors should be aware of?
That's a great question, Derek. So if we think back to the parameters of the dividend aristocrats, remember they have to have paid a dividend and increased the dividend over the last 25 years. So by its very nature, that means that the aristocrats are going to exclude any new firms, any new technology firms. And if you look at the exposure of the S&P 500, if you think about the top 5 firms, so Apple, Microsoft, Amazon, Facebook, and Tesla, those firms, they're pretty much in the technology space, and they account for 20% of the S&P 500. What's interesting about the S&P is that back in the 1960s, in the early 1960s, the average longevity of a firm in the S&P was over 60 years. And now, according to McKinsey, it's about 18 years. And in fact, by 2027, McKinsey are estimating that about 75% of firms in the S&P will no longer be there. So if you think about the growth that we've seen in the markets in recent years, a lot of that has come from technology. And those technology stocks, as I say, by their very nature, are not going to be in the aristocrats index. Instead, the aristocrats tend to overweight sectors like consumer staples, industrials, and materials. And in fact, the 3 of those together account for 70% of the exposure of the aristocrats index, whereas they're only about 18% in the S&P 500. So what we've seen, therefore, is that the aristocrats is ignoring or leaving out those firms that have performed most spectacularly over the last 10 years, the high-flying technology stocks. So somebody who chooses dividend income is, perhaps unbeknownst to themselves, is actually making a sector bet. They're choosing to eliminate technology.
Are there any dividend investing ETF strategies that have done a better job in recent years in terms of sector allocation to technology or communication services? How would an AI member, or really any investor, find and follow a given approach?
Yeah, well, I guess one fund that they could look at is well, first of all, obviously they should make sure to read the dividend investing articles in the journal and pay attention to that.
Thank you. Nice plug.
That part of the website. But one fund I could throw out there, for example, or one ETF, is the Vanguard Dividend Appreciation ETF. And that has outperformed the aristocrats by about 2% annually over the last 5 years. And you may say, well, why is it outperformed? Well, following up on my thesis, if you look through to the sector allocation of the VIG, the VIG, it has more, because its requirement, its criteria is that a firm has paid dividends for 10 years. it can afford to include a lot of these newer firms like Microsoft, like Apple. I'm not saying they're specifically in the VIG right now, but they are eligible to be included. And so as a result, the VIG has a technology exposure of about 13% versus the aristocrats, less than 1.5%.
Thank you, Brian and Derek, for that great interview. I want to invite people, if they want to know more about the Dividend Aristocrats or the various sectors, to check out the article entitled Viewing the Sector Exposure of Dividend Stocks Through the Aristocrats in the March 2021 AAII Journal. You can find that in the print publication as well as online, aai.com/journal. Thank you.
Thanks, Ryan and Derek.
Charles, I wanted to talk to you about risk in one's portfolio. How do you define risk?
Well, there's a couple ways of defining risk. One, the way I like to define it is just not having the money you need at the time you need to spend it. Our founder, Jim Clunan, defined risk as having less wealth at the time you need to take withdrawals than you could reasonably expect from a given strategy. They're both really closely related, but it really comes down to if you have a long-term goal and you're trying to reach that goal, or even a short-term goal, it really is a chance of not having the money you need to fund that goal. Now, people tend to think of risk in terms of investing as volatility, but no one complains when there's volatility to the upside. It's only to the downside. So volatility itself, downward moves, is a risk over the short term, and it's really not so much volatility as sequence of returns, meaning having a bad stretch of returns at the wrong time. And you can certainly control for that regarding allocation, but volatility itself, particularly if you're a long-term investor, Clunan defined it as phantom risk. And really, although it might affect how you psychologically feel about the markets, for most investors with a longer-term time horizon, if their allocation's correct, it really is not a risk, as more as something that might cause you to react emotionally.
All right, so there's timing, financial, and psychological factors that play into risk. Is there a way to generally categorize yourself when it comes to risk?
There is. We have a risk tolerance questionnaire that's part of the wealth building process. It's a 6-question questionnaire that we ask members to fill out, and we'll actually help them score to see where they're at. So it runs from very conservative to very aggressive. And we do ask people to consider the time horizon of their spending, how much they're going to spend relative to their wealth, 2 big factors from a financial standpoint. But we also discuss things like, what you've done in the past. Have you panicked before? Or have you been able to withstand bear markets? What's your financial knowledge? Because we think the more you understand what's normal in markets, the less you're going to react to it. So we consider several different questions to help people assess exactly where are they, both from a financial standpoint, but also from a knowledge standpoint and from a psychological standpoint. And it's really important to understand that as part of that questionnaire, we ask people to go back and look at what they actually did during past market downturns, because a lot of traditional brokerage firms will ask you a question that basically says, if you have an investment and it drops 20% or 30% over a short time period, how will you react? On the base case, that sounds pretty a good way of assessing risk, but the reality is how you answer that question really depends on how you're feeling that day, what the markets are doing. So we're trying to actually get a sense for people. We're really trying to ask people, what have you historically done? The logic being that in the past, if you panicked, and now you're taking this risk questionnaire and the market's on a really good state and the market's on the up, or actually in the uptrend, you might think to yourself, well, I'm okay with standing a bull market. I won't repeat the same I won't repeat the same behavior. But the reality is, if you have panicked in past bear markets, it might be a sign that you're not as risk tolerant as you might think you are from an emotional and a psychological standpoint.
Answering this questionnaire and walking through the 6 key questions sounds like a pretty good initial step in the individual investor wealth building process. But knowing what your threshold for risk is and acting on it are two very different things. Once you determine your threshold, how do you go about tuning your asset allocation appropriately?
Well, we have 3 asset allocation models that we give members to follow, or at least use as a basis for determining their allocation. That really comes down to your goals and your risk. So you might have a long-term goal that calls for a very aggressive allocation, but you may not have the psychological ability to stick with that allocation. And in such cases, you're actually better off going after a slightly lower rate of return, because if you're better able to stick to that strategy consistently over the long term, you'll end up with more wealth than if you take on too much risk in terms of the strategy and you're unable to stick with it. On the flip side is you might have a lot of wealth and be able to withstand a lot of market volatility, but your risk tolerance might be lower. Perhaps your short-term goal is actually pretty short-term. So you might be thinking, I don't care what Mr. Market does. I can withstand any volatility he throws at me. But if you need to catch a withdrawal, say in 2 years or 3 years, well, then that should be a sign, or that should really be a signal to you that you need to adopt a more conservative allocation than you feel like you need. Because if you absolutely have to spend that money and you're looking at, say, a 2-year time horizon, then you shouldn't necessarily have it fully allocated to stocks if it means incurring a loss in that money causes you not to be able to fulfill your goals. So there's really 2 aspects. It's not just here's my risk tolerance, but really what are your goals and what are your risk tolerance, and really trying to mend the 2 and apply those to the asset allocation, and realize your goals and your risk tolerance might actually be different, and sometimes they might actually contradict themselves, and it may mean that you need to make an adjustments accordingly.
Well, thank you for that, Charles. Folks can take a look at Challenge 2 of the Individual Investor Wealth Building Process. It's called Determine Your Tolerance for Risk, and you can find out more about that at AAII.com/learn-and-plan. You'll also find a handy worksheet to work through what your risk tolerance is. Wayne, I wanted to talk to you about the recent stock trends you're seeing among the portfolios in AAI's Stock Superstars report, what we call SSR internally. For those who are unfamiliar, the Stock Superstars report follows 4 superstar approaches based on the methodologies of some of the market's greatest investors. Just to review, Group 1 follows William O'Neill, Group 2 follows David Drimmon, Group 3 follows James O'Shaughnessy, and Group 4 follows John Neff. Wayne, what broad trends have you seen amongst the stocks in these 4 groups?
Well, actually, let's back up just a little bit. Just want to touch on the fact that, as Ryan mentioned, the Stock Superstars report follows 4 distinctly different selection strategies. And the rationale behind that is, no approach, no investment factor is going to outperform the market all of the time. So what we did when we were building the SSR portfolio strategy back in 2002 was we looked at some of the top Wall Street superstars over the history of the market, and we found at the time 4 distinct strategies that have performed very well, but were very different from each other. And that was the basis for SSR, is to identify these superstar investors and use their methodologies to create individual portfolios. But at the same point in time, recognizing that they aren't going to be operating in lockstep. And so there will be periods of time when some strategies are going to do well, very well. Other times, these same strategies might lag others in the portfolio. So that is the reason why we use 4 distinct strategies for the SSR portfolio. And what's been going on in the market over the last year really underscores the need for being at least flexible in the strategy that you follow. We've noticed, overall in the marketplace, last year was a very good year for large cap growth stocks, specifically technology stocks. So, the FANG stocks, Facebook, all of those types of companies. Those were very strong through most of the year. But as we neared the election, we started to see in November, basically starting in September, we started to see a shift where value stocks and small cap stocks, which had been performing very poorly. A lot's been written about value lagging growth over almost over a decade now. But we started to see a rotation away from these large cap growth stocks into more smaller stocks, more value oriented stocks. And that's what we saw in the SSR portfolio. Our Group 1 William O'Neill Canslem approach, which is a very high growth, price momentum oriented strategy, ranked first or second in all but one of the months through August of last year. So that was really leading the portfolio for much of the year. But then as we started to see a rotation out of these large cap growth stocks, we started to see other strategies that focus more on small cap or deep value starting to outperform.
Focusing in on Group 3's O'Shaughnessy Value Composite strategy, how has that group of stocks and value-oriented strategy fared in the market recently?
Well, and actually, that is what really started to pick up the overall portfolio in the latter half of last year. The Group 3 O'Shaughnessy portfolio, actually starting in September, I believe it was. Yes, in September, actually from September through February of this year, ranked either first or second in each of those months. Whereas it was ranking either like third or fourth for much of the earlier part of last year. So again, we're really seeing that rotation, which the O'Shaughnessy approach is a very deep value methodology that also, because by its nature of being deep value, also tends to uncover very small companies as well. And both small cap companies and value really did very well in the latter half of last year.
I did want to ask a little bit about portfolio additions or deletions across the 4 SSR groups. Could you give our audience just a brief word on the factors that lead to adding or deleting a stock, and also generally speak to any stocks or sectors that are on the bubble for addition or deletion?
Well, I mean, generally speaking, we have 4 distinct strategies that we use to identify stocks that we add to the 4 SSR portfolio groups. And based on the factors and qualities that we look for on the buy side for these 4 different strategies, we also use these same factors to identify when stocks might be deleted from the portfolio. So, those really come in handy, especially when we start seeing the market starting to get a little wonky, like it was even last week around the election of last year. So what we're seeing, generally speaking, is any stocks, any strategy right now that is heavily momentum oriented, especially with the market starting to wobble a little bit last week. Those are starting to jettison some stocks. We have seen as well the number of stocks that have been passing our more value oriented strategies. Those universe of stocks are starting to get a little bit smaller as the market has been now on a pretty good tear now since following the November election. So, generally speaking, momentum is falling out of favor a little bit. Large cap falling out of favor a little bit. Again, more appreciation and more focus on small cap companies and more value-oriented approaches.
In general, the longstanding AAII advice is to take the long view on adding or deleting stocks from your own portfolio, and follow or set your own parameters and rules for doing so. But of course, the markets being what they are, the temptation to act is always present. What would you say to those investors who are following the SSR portfolio in the context of the current market environment?
Well, as I alluded to a little bit earlier, was the fact that we have rules-based strategies to both add and delete stocks from the SSR portfolio. And, I've been investing now for almost 24 years. And one of the things that I've learned, learned the hard way sometimes, was that when you buy a stock, at that point in time, you should have a very good idea of what needs to take place for you to sell it. Otherwise, when you start seeing the market getting a little jittery like it was last week, your first reaction is, do I need to get out? So there's that panic selling that might be taking place. There's also FOMO, the fear of missing out. You might have a strategy that works very well for you, but it might not be identifying, those sexy stocks out there. So you're seeing everyone jumping on the, GameStop. Everyone was talking about GameStop a couple of weeks ago. Well, just because the market's talking about it doesn't necessarily make it a good investment. And that's the distinction that I always try to make from people is, are these good investments? Most of our members, myself, as well as the SSR portfolio, tends to take a longer term view of things. But for each of our strategies, we have a very explicit sell rules. So, last week, for example, we deleted a stock from Group 1, which is the William O'Neill CanSlim oriented strategy. High growth stocks, high price momentum. We sold that stock because even prior to what was going on in the market last week was the price momentum of the stock that we deleted had deteriorated enough that it had activated our rules-based sell alert. So if you have these rules-based addition or deletion rules, it makes it very easy to navigate when the market starts getting a little jittery or even starts rolling over and enters into a correction.
Sounds like some sage advice. Thank you for that, Wayne. If you'd like to learn more about the SSR portfolio or already are an SSR subscriber, I would recommend checking out stocksuperstars.com and reading more from Wayne's monthly and weekly SSR commentary available on the latest tab of the website.
Thank you, Ryan.
And now for our listener mailbag segment, where we address questions that have been submitted by viewers and members and answer them here. If you have a question for us, you can submit them using the questions panel in your GoToWebinar control panel, or email me, rreeh@aaii.com, with the subject line, II show question. All right, Charles, these questions came in and I wanted to have you answer them. This one comes in from George V. They ask, why do you still use price to book for the shadow stock portfolio in spite of the accounting issues related to book value?
No, that's a great question. So there's questions about how companies have their balance sheets set up. And because of things like intangible value and recognition of that, there's questions about whether or not price to book value is still a valid measure. But I'd point out, if you look at even a more popular measure, price to earnings, the earnings number is filled with accounting decisions. If you look at enterprise value to EBITDA, again, accounting decisions, how they manage their debt load. So at any single indicator, there's certainly criticisms we can level at it, which is not to say any of those are bad, but just understand that you can't single out one without realizing there's other issues. Now, the case with price to book value, there's a very long history of it working. Our shadow stock rules are really based on the Eugene Fama and Kenneth French studies back in the early 1990s that showed that if you buy stocks with low price to book values, they do tend to outperform. So it's a key part of their 5-factor approach to explaining returns. One of them is price to book value, or as they use the inverse, market value to book value. So that's why we have a long history of using it. The shadow stock portfolio itself, however, is based on academic research. Over time, we have tweaked the rules. That started with Jim Clunan, our founder, who evolved the strategy as time went on. We're constantly reading new research. As an organization, we tend to be fact-based. We do want to listen to academic research. And we are looking into the possibility of including things like our value measure, which is a multi-variable approach. It considers several valuation ratios. So it's something that we're looking at. But right now we're using price to book. And I'll point out, because we use price to book, people can see our rules. It's very transparent. And anyone who wants to manage your own shadow stock portfolio can actually look at what we're doing, has all the tools out there, and can really look at price to book on anywhere they want to determine which stocks might be violating our valuation sell rules and which are not. So a long history of price to book working really well. We're going to continue using it, but we're always paying attention to new research. And it's possible at some point in the future we might evolve our rules further again.
All right, thank you for that clarification. This next question came in from Jane D. She asks, in his groundbreaking book, Investing at Level 3, our AAI's founder, Jim Clunan, did not recommend option investing, calling it a, quote, zero-sum game. What are your thoughts on options?
So for those people who are not familiar how options work, options are basically a contract to buy or sell a stock or an ETF at a certain price by a certain date. Most option contracts expire worthless. So if you're holding an option contract, it's a bit of hot potato. You want to get rid of it beforehand. Now, there's a lot of option strategies, including selling options, which means you're hoping to profit on the option contract by expiring worthless. The thing with all option strategies is they look a lot easier when someone's demonstrating how to follow them than it actually is in the real world. There was one study by Reuters several years ago where they looked at option trades by individual investors, and they found a high percentage actually lost money. Some people have had success with trading options. If people are doing it and it's working well for them, and they feel really knowledgeable about it, I'm a big believer, do what's working well for you. But I think for people who are really new to options or kind of thinking about it, I would advise to tread really carefully. But even stepping back from all that, I think it's really important to realize what causes most people to underperform, and not just individual investors, it's also institutional investors. It's simply not getting that basic mix of stocks, bonds, and cash correct over the long term. If you just get your allocation strategy correct and have it being oriented relative to your goals and relative to your risk tolerance, you're going to have returns far in excess of the average investor. So while options might seem really nice, the reality is really focus on just getting those basic cornerstones of allocation right, and just do that. You can always get more complex with investing, but a challenge for a lot of people is just to get to do things simply, but do things simply correct over the long term. And that's where a lot of people, regardless if you're an individual or your institutional investor, say you're a really large pension plan, getting that basic stuff right is really going to boost your returns over the long term.
All right, thank you, Charles, for answering all of those, and thanks to the listeners for submitting those questions. Again, if you have a question for us, you can submit them using the questions panel in your GoToWebinar control panel, or email me rreeh@aaii.com with the subject line II Show question. We will get them on air for the next Individual Investor Show. If you liked our show, please visit aaii.com/webinars to register for more webinar and video content. Like us on Facebook, and follow us on Twitter at @AAII_invest_ED. For more investing education, check out our website, aaii.com. Again, I want to thank our guests, Brian Haughey, Derek Hageman, Charles Roplet, and Wayne Thorpe, and you for listening. We'll see you next time.